Okay, welcome back, everyone. Picking up from that last panel is a challenge. It was very informative and instructive, but we're up to it on this panel. I know it. So my name is Olivier Lebleu. I head the ESG practice here at Edelman Smithfield in London. And today we are going to be, as Andy reminded us, talking about a fact, which is that we are post-COP26. So we are going to lead with that theme on the ESG and sustainability panel. I'm delighted to be joined on this panel by three subject matter experts from different firms. So Amanda Young from Abrdn is joining us today. Amanda is the Global Head of Responsible Investment for Abrdn. Jeremy Taylor is the UK CEO for Lazard Asset Management. And Stephanie Maier is the Global Head of Sustainable and Impact Investments at GAM. So we are the ESG panel, but I'm going to take the ES and change the last letter in terms of what we're going to talk about. We're going to talk about engagement, we're going to talk about stewardship, and I think we're going to talk a little bit about activism as well. So ES and A are going to be the way we talk about ES and G on this panel. And I'm delighted that despite all the restrictions and changing rules, two of the people in the room are actually fellow subject matter experts who have specific insights and points to make on some of these ES and A issues, and they'll be able to interact with our panel, adding to additional subject matter expertise. So looking forward to that interaction. So starting with COP26, which is just behind us, for the benefit of my fellow panelists and for the audience, the Edelman ESG team wrote up a quick summary post-event, and our conclusion, broadly speaking, was that in seeking to avoid making the perfect the enemy of the good, the COP26 conference basically was not very perfect and probably not very good in terms of outcome and in terms of final agreement. So the governments have spoken, and we're sort of dissatisfied with the outcome, which means that the private sector now has to step in. And for the private sector, for this discussion, I really mean the investment community and the corporates. And so on this topic of engagement, we have a lot to do, it strikes me, in terms of how to engage post-COP26. So I'd love to hear from each of the panelists in turn in terms of your priorities going into 2022 for the engagement topics, particularly on climate, that you expect to prioritize.
Hello, it's lovely to see people face to face and know that somebody's actually listening to me for a change. So lovely to be here. Thank you for having me. So for me, I'm not actually going to speak about climate change specifically. What I want to talk about is natural capital or biodiversity, because whilst it's intrinsically related to climate change has been around for a long time, and I think there's a lot already happening in the space. You've got Climate Action 100+, you've got investors coming together to talk about pushing decarbonisation from the companies that they're investing in. However, I actually think the next big thing is this natural capital, and it is intrinsically linked to climate change, but it comes back to some of the comments that were made in the earlier panel session, which is actually the cost of raw materials. So if we think that the majority of our economic output is somehow reliant on raw materials, and actually over half of it is probably quite exposed, both from a kind of medium and high risk, to raw materials and natural capital, that for me is one of the biggest things that we as investors should be looking for. Now, natural capital is also essential in the fight against climate change. We had the deforestation commitments at COP, which was brilliant to see that we're actually talking about how we use our natural capital as a solution provider. We also heard earlier about sustainability being a big driver for some of the sectors, and I think it will continue to be, but as investors, our key aim is to make sure that we're not exposed to risk, as well as seeking out those opportunities. And I think there's been a lot of discussion about climate change solution providers and actually what we can invest in that will preserve our world around us. However, the risks are huge, because if we think that we are currently reaching Earth Overshoot Day, which is the day in the year that we use all our natural resources that we can replenish, and that is now July, end of July, we are using the natural resources we can replenish. We, every year, are living 5 months of the year on things that we can't replenish. Now, anyone who's got an economic head understands supply and demand, there is going to be a crunch issue. And so that, for investors, we need to be thinking about as we factor in our analysis of the stocks and real assets and private assets that we're investing in. Where is that crunch point from a natural capital going to be? And so engagement is a very important tool as investors to go and speak to your underlying investees to find out how they're managing their natural capital exposure, what is their natural capital exposure, what is their natural capital risk, and what governance processes are they either thinking about putting in place or currently have in place to manage that. So we've also seen in the last 18 months the launch of the TNFD, so that capitalized on the TCFD from the climate-related financial disclosures. Well, actually, we're starting to see a move from investors to get companies to think about natural capital. So for me, that is going to be the big thing in 2022 and beyond.
Very good. Jeremy, can I ask for your perspective on the key themes you see from an engagement perspective?
Yeah, sure. So maybe I should just explain my positioning first. So it may seem quite unusual to have the CEO of an asset management business on the panel here today. But I've been an investor at Lazard for the last 15 years and only the CEO for the last 3 years. And I see our role with our clients as really being, the investment partner to all our clients. And so it's important that actually throughout the organisation we really understand the challenges ahead of us. Over the last 5-10 years, the focus on ESG and sustainability has continued to grow. Disclosure requirements for companies have been rising. We can all map out Scope 1, Scope 2 carbon emissions across any portfolio or any individual sector today. So really, when we're looking forwards and thinking about the 2030 and the net zero targets, what we should be thinking about is the CapEx which companies are deploying. Because it's in understanding where capital is being deployed is how you understand how the trajectory of companies' products and services and the way they're operating the businesses is going to change over the next 10 years. Our base philosophy is focused around, return on capital. And so it will be natural for us to engage with our companies around CapEx. But let me just spend a couple of minutes on it. So, today most companies report CapEx at a group level and maybe even separate it out to a divisional level. But there's very little disclosure around the difference between maintenance CapEx and future CapEx. And then even looking at that, there's little disclosure around what you might consider to be green CapEx or CapEx that allows a company to transform itself. So what we're looking for is actually increased disclosure around CapEx and the engagements we have with companies and the discussion and debate we have. We're doing 4,000 company meetings a year across our group, and we have a huge resource of research analysts. But it's so important that they're focused on this particular area of businesses to really map out and understand how companies are changing. And I'm sure we're going to get into individual sectors and perspectives on different parts of it. But I think that's the message that I wanted you to take away today.
So CapEx as a research lever for engagement. Yeah, very good. Stephanie, what's your perspective? And perhaps also, we heard a little about the forums that are out there already. Which forums do you think are also useful perhaps for engagement looking ahead?
Yes, I think firstly to say that actually private sector engagement at COP was quite significantly different from comparing it to COP21, and I think that was one of the main takeaways. So regardless of what was sort of negotiated in the blue zone, what you saw was absolutely investors and corporates seeing this as multi-decadal shift, something that needs sort of proactive action and strategy, and actually some of the sort of commitments and statements that were made around COP also spoke to that, I suppose, that need to go from the commitment to the action. One of the things we'll be focusing on is essentially the transition planning piece. So, we have net zero commitments from the investor side, we have net zero commitments from the corporates, but how are they going to get there? 2050 is a long way off. What's going to be happening in 2030 and 2025? So really focusing on that sort of disclosure piece of how do companies articulate what a credible strategy looks like, and provides evidence in the form of capex as one of those indicators, more specific targets, that they've really understood this challenge for themselves and for their sector. And I think key there, and we heard a bit about it on the earlier panel, is the sort of the value chain piece as well. Transforming these sectors can't be done as a single sector. It's cross economy, cross sector piece. So what we're already seeing is a lot more, I suppose, sort of collaboration and dialogue across sectors when we're trying to unpick some of these barriers to decarbonisation. So, how do you link the demand side and supply side? How do corporates make sure that their value chain is resilient, given the, I think we will see a sort of squeeze on some of these solutions. So I think the key piece there is the sort of the transition planning, and what does that credible transition plan look like? And I think that's also, there was a lot of focus on disclosure at COP, and more, so greater around the harmonisation of sustainability disclosure standards, and Rishi Sunak announced sort of the intention to have transition plan requirements for UK corporates. The point is, what does a good transition plan look like is going to be really, really key. And one of the key things is we're now going into much more specific forward-looking metrics. So, all the ESG data has traditionally been, okay, what was last year's carbon emissions, what were your last year's figures? Now we're going into, strategy. What is your investment? What is your R&D? Where do you see those strategic opportunities? And, yes, climate has very much been framed and rightly in a kind of a risk context, but we're really interested in that opportunity piece as well, because we see this, entering into a massive phase of basically, disruption, change, policy-driven, consumer-driven, and those companies that actually see where they can help provide those solutions are going to benefit from that significantly. If you want to pick up on the second question around some of the sort of collaborative engagements, I'm on the steering committee of Climate Action 100+, that Anne's already referenced. And, we launched in December 2017 at the first One Planet Summit through Post-COP26. And what was really key there, and what we've seen considerably grow, is investors coming together to say, companies need to govern their climate risk, they need to align their plans and their targets with the Paris Agreement, and they also need to disclose, how they're doing that. What we've seen now is, we're now sort of 600 plus investors globally, 60 trillion under management. That's a big chunk of the private market saying, these key companies need to transition. And there is, in March we launched the net zero benchmark. One of those indicators was capex. Again, short, medium-term targets. And I think what we're seeing in those large collaborative initiatives is just very clear expectations from investors that they want to be investing in these companies that are actually up to the transition. And these are the big companies that, if they do it well, they're still going to be around. If they don't, they're really going to suffer.
Yeah, I think that's the key, actually, next point. So it's a great way to transition, which is investors have stepped forward. They've put frameworks in place. They keep coming up with new frameworks, as we just heard, in terms of natural capital as well. And it's creating a reaction function on the corporate side to say, okay, I have to sort of adopt these frameworks. And I'm going to bring in one of our audience members here who has some subject matter expertise on the issue of stewardship, because what I'd like you to react to is, okay, so we've got frameworks. We've got big numbers behind the frameworks, but what is the accountability that you sense, or what is perhaps best practice from an accountability perspective when it comes to engagement and then getting boards of corporates to actually be held accountable for some of these targets, some of which, I think we can all agree, are set pretty far into the future, and therefore current boards may not feel entirely accountable for them. So before I go any further, I'd like to bring in Veena Romani, who's the research director of Focus Capital for the Long Term, a member organization. Full disclosure, Edelman is a member of this organization, but there are other members of the panel, and throughout the day we're also members. But they have worked on a engagement tool for boards, particularly for boards that don't have climate expertise, to engage on climate issues. I'd like you to maybe bring out the main points of that and have the panel react to your comments.
Sure. So great Can you hear me? Great.
Yes.
Great opening remarks. And I'd like to pick up on a couple of themes that all of you have raised. The issue of transition planning, the issue of CapEx disclosure, and the fact that neither of these themes are really being reflected in corporate disclosures right now. So we at FCLT did a little bit of a back-of-the-envelope exercise where we looked at the top 100 by market cap companies in the MSCI ACWI Index. So a good diversified list of global companies. And we tried to sort of map the gap between those that had set net zero targets and those that were reflecting these net zero targets in their disclosures of their long-term strategic plans to their investors. We expected to find a gap. We found a chasm, right? 81 out of the top 100 companies have set net zero goals. 15 of them mention climate in their long-term strategic plan disclosures to investors. And we were liberal graders, right? We gave credit for a bullet. 5 of them did it well. So this sort of motivated us to really focus on the importance of robust but integrated strategic planning. So not just a climate plan, a climate transition plan, but a climate transition plan that was integrated with the company's long-term strategic plan. So we released a tool around COP26 called our Climate Transition Conversation Guide, which is intended to be a set of questions that boards can ask management, that management can ask itself, or that investors can ask management on how climate affects every aspect of its long-term strategic plan, starting with the purpose of the enterprise, right? What is it? How is that affected by climate change? What's the external environment within which a company operates, covering things like value chain that the panel has addressed? You know, how are goals and targets, how are existing financial business goals and targets affected by climate change? It covers things like CapEx, critical, right? Clearly a focus of Climate Action 100+. It covers the risk approach, and it covers accountability. So that's the tool. It's out there. But yeah, I mean, I guess my question to all of you is, especially, I mean, there is, as you pointed out appropriately, a huge focus on climate change disclosures and rules for climate change disclosures, getting getting the floor up on that in the marketplace. But how do you see climate transition planning, you know, fitting as a part of that? So clearly we've seen the Rishi Sunak announcement, we've seen the TCFD guidance, but love to hear your thoughts on how investor engagement can get companies to not just disclose, but disclose strategy.
Do you want to pick up?
Yeah, I'm very happy to kick off. I think it's great that tools like this are being developed. I'm going to be slightly controversial, because I like being controversial.
Please.
Climate change is not the only sustainability issue that we need to factor in as investors. And we as investors need to recognize we are there to invest the persons on the streets' pension money for the long term. So that has to be the fundamental starting point for all of this. So what I would say, within those largest 100 companies, there will be companies there that should absolutely be at the forefront of making sure that their long-term strategic plans are capturing how they are exposed to climate change, because climate change is such a big risk for them. And it's a big risk for them because of the changing nature of regulation, changing nature of energy use, changing nature of consumers. However, I would also argue that in that 100, there will be areas like in the ESG space that are far more, in my view, relevant from a risk perspective. And that's where the challenge is, because there are a lot of issues that we need to be thinking about. So those companies that are very heavily exposed to inequalities, for instance, those companies that have a lot of low-paid staff and very reliant on human labor might be far more exposed to that issue than climate change. So when we come to doing our investment engagement, things like Climate Action 100+ are useful, because that's exactly what they've done. They've highlighted those companies that are most exposed to that issue. So I think your frameworks are brilliant. Companies need that, so well done. But what I would say, I mean, Stephanie and I have been around in this industry for quite a long time, and there is definitely a lot of what I would call ESG fatigue, or sustainability fatigue. And I know I'm feeling it, and I know a lot of my other colleagues who used to sit in dusty cupboards saying, can we come out and speak about these soft issues? And people are like, well, why would we want to do that? We need to recognize we have come a huge, long way. 20 years ago, if I sat in front of a mining company, the sorts of questions I would ask them is, do you have an environmental policy? And the sorts of responses I would get were, why would I need one of those? Now, you can't even imagine today that an environment, a mining company doesn't have an environmental policy. So actually, I think we've made a huge amount of progress, and the tools that you're talking about, I think, are really helpful. But we also need to recognize that not all ESG factors are going to be relevant for all companies, and we mustn't forget about the fact that we as investors are not just exposed to public listed companies through bonds and equities. We've got infrastructure, we've got private assets, we've got real estate. And so for us, that net zero thing needs to kind of fit into all of those. So what I would say is that risk assessment in terms of what the risks are really important. And then being able to use frameworks to target those companies with the biggest exposures are going to be the most important thing, in my view.
Great. Well, I mean, I think I should change tack slightly, because there's a reasonable risk that we actually all agree with each other and say very similar things, because we also develop frameworks in terms of how we're engaging with companies. And in fact, one of the sort of comments around COP, coming into COP and coming out of COP, has been, it has the great resignation which has happened in the employment space, has it become the great spin-off within the listed equity space? Because lots of companies, they try and sort of improve their profile, particularly because they're listed, very transparent, very exposed actually to the way they operate. Have actually been selling assets into the hands of private equity, where they have actually much shorter horizons, 5-year horizons, maybe 7-year horizons, and they may not have the same responsibility in those spaces. So I think there's, within the engagement with companies, it shouldn't all be about disposing of, extractive industries almost. It's actually making sure that in certain circumstances, assets are almost ring-fenced, and say, actually, we're going to run off this asset now, and we're going to use that capital to reinvest actually more positively. And I actually think if I just pick out some of the sectors for a moment, because I think if you look at the economics of climate change and the economics of renewable energy, then things have really changed in the last 3 years. So Lazard's been doing this levelized cost of energy study for 15 years, way before it was even interesting or popular for anybody else. Because we were, on the advisory side, we were being tasked with the question about, when should the utility companies start to invest in renewable energy? And there was a real crossing point in 2018, the end of 2018, where wind and solar, fully costed, were less expensive than nuclear, gas, coal-fired power stations to produce electricity. Now, that was without subsidies. So adding subsidies on top of that for a period of time, that's why there's been such a significant investment. But what it really means going forwards is there's now an economic incentive to drive towards renewable energy. That's going to drive electrification. And if you look at the 3 large sectors which create the greenhouse gases, 40% is coming from power, the next 20% is coming from transport, and then there's a 10-15% coming from steel, cement, industrial kind of use. So actually, the economics are changing here. And so going back to your point about how many of these companies are talking about their strategy, their change in strategy, it's the ones that are really seeing the investment opportunity and see this, they recognize the challenge they're having against maybe their existing business, and they recognize that over the next decade, there is a material change that they need to understand, an economic change as well as a sort of societal kind of challenge. They need to change what they're invested in and what their businesses are doing. And that's our job as investors. What I find really, really interesting, because you read about sustainability right across the press all the time at the moment, is the one section of society, the world, with the longest time horizon is actually a lot of our clients. Yeah. I mean, they've got a 30-year time horizon that they need to think about their liabilities over. So this is really important to them, in terms of the overall outcome, for their pensioners and for the capital that's being saved up for them. So So I think those are my remarks coming from a slightly different perspective.
Yeah, very good. Stephanie?
Yeah, I think, any of these frameworks and any focus on specific sustainability issues essentially serves to, I suppose, highlight the key issues around, board competency, board effectiveness, do you have the right people in place? And so it goes back to the sort of the broader governance piece. I think what we're seeing is, obviously, one of the elements is the sort of disclosure within the strategy, and obviously that is what TCFD guidance is trying to do. But the point is, do you have the right people on the board that actually understand, climate change as an issue as it relates to their sector, but also changing consumer trends, the kind of the broader issues that the companies are exposed to as well. And I think, what we're seeing now from investors as well is actually looking quite specifically at the board, at the individuals around the board. Are they diverse? Do they have diverse perspectives? Do they have the right expertise, skills, experience to enable, the company to navigate the next period of time? And yes, is that, well articulated in the strategy, and is the board really in place to help deliver that? And we've had guidance. So I think WEF came out with some sort of board level guidance. There's also Chapter 0, which is focused on non-executives and their role in challenging and bringing these conversations into the board more. Summer we've obviously saw ExxonMobil case where specific new directors were put on the ballot and got into the onto the board. Now that's quite a shift from the sort of shareholder resolutions that are essentially asking companies to do something. It gets enough support, the company's then obliged to come back with a policy, a strategy, whatever that ask was. We're now actually seeing those boards being specifically changed at the individual director level, and we're going to see a lot more of that. We're already seeing voting policies focusing not just on for example, focusing on chairman of nomination committee if the board's not sufficiently diverse. We're already seeing individual directors being held accountable for specific issues or inaction on specific issues. But again, I think it just comes back to the broader issue of governance. What do good boards look like? Do boards have the right skills? Do they have the right interaction and dynamic with the management team to be able to, oversee that strategy and deliver on that strategy, which is, ultimately what the investors are seeking them to do.
That's an excellent point that you raise in terms of board competence. It brings us to my last of the three letters that I mentioned at the outset, which is A, activism. So we are starting to see, aren't we? You mentioned ExxonMobil, of course, with engine number 1, getting directors changed. We've just seen it this week here in the UK with SSE being targeted by an activist. And one of the points made in the activist letter is that they don't feel that the board is sufficiently competent on renewable energy. And if they had been more competent, perhaps the company would be more highly rated. It's not for us to decide that here today, but that is what they said in their letter. We have somebody in the audience who works a lot with activists. Cass Sidorowicz is the CEO of Georgeson, one of the world's largest proxy firms. Cass, I know you've looked at this for your clients. Maybe 2 or 3 points that you would like to make on what activists, when they come to you, what do they say is most relevant on this issue of competence versus the ESG risks that we just discussed?
There's a convergence happening right now where you're seeing major activist investors such as Third Point, Elliott, bring up ESG issues. If you think back, maybe I think it was just over a year ago or just under a year ago, when Third Point went after Prudential, one of the throwaway lines in the public letter that they used was the corporate governance, the carbon footprint of the London presence of Prudential's London headquarters, which was not a serious threat and it wasn't a real concern. That's changed. Third Point is going after Royal Dutch Shell, looking for them to hive off or divide the assets. We saw with Glencore and Bluebell earlier in the week, challenging the board specifically as to how they could be committed to some of their environmental targets and still continue to extract coal from the ground until 2050. Activists recognize that there is a gold rush in terms of asset allocation to ESG investing, and firms not only Bluebell and Third Point and others, are looking to capitalize on that, to grow their assets under management, and to hold their portfolio companies to account. And they are using ESG and COP26. I think the Royal Dutch Shell Initiative, I think the Glencore Initiative are all directly related to COP26 as a date in the calendar that everyone has been focused on for so long, and that there is so much of a rally right now to look at these issues that they're trying to ride that wave and call on other investor support for some of these initiatives. Now, activists make money by, assets under management, and they may make more money than some other asset managers in terms of their allocation, and then they make a very significant benefit on the P&L of any campaign that they run. So getting someone on the board isn't going to create the share price to pop. It's what those directors do once they're on the board. And so understanding who the activist is and what their long-term objectives are. All activists, like I'm sure everyone has read today, how do you define a party, right? Is it wine and cheese, or is it something more significant? All activists run different types of campaigns, and who the activist is as important as to what they're asking.
Yeah, and I think this brings us to the last point I'd like to ask the panel. This is ultimately the point about the arbitrage of time horizons. Jeremy made this point. You represent longer-term oriented institutions. Kaz has just helped us bring up to date on what shorter-term oriented institutions tend to do. How do you think we can resolve this in terms of, perhaps engaging with activists when you think the issue has been properly laid out, or perhaps, on the contrary, being on the side of the longer-term planner? So what's your reaction?
So I think it's really important for any asset manager to have proper subject matter expertise when it comes to ESG issues. And, we spend a lot of time talking to our investees, but actually when you do engagement, it needs to be broader than just the companies you're investing in, because you actually have to think about what are the risks or opportunities facing the companies. So people who've been in this industry for a long time, Stephanie included, can talk to you about how they do speak to activists, because actually the activist voice could be the thing that pushes bad headlines, negative publicity. So go right back to 1991, I think it was, Shell and Brent Spar. Shell wanted to sink its platform into the North Sea, and it was overtaken by Greenpeace activists who said this is just not going to happen. And actually what that did is it changed a movement. It changed the company's recognition that it had a duty beyond just a pure business one. I worked for the Church of England for many years, and the voice that the church had with engaging with companies had to include the person on the street, the underrepresented, the people who had been repressed, because they came to the church and said, you're shareholders in these companies. And in Nigeria, for instance, there was a big campaign for many years to get the church to use its voice as an investor. So there will be a number of investors out there that have a moral duty on behalf of their constituents to make sure that they're actively engaged. So listening to activists is really important because they have a voice, and that voice needs to be understood. But sometimes it's about broking a dialogue between your end investors and people. But your point about what is an activist trying to achieve for investors, that's the most important thing. Because if you want somebody on a board to drive positive change, that's great, because that's what you want. You think that's going to benefit your shareholder price over the longer term. But if an activist is getting on the board because it doesn't like the business model of the underlying entity and wants to change it completely, that's not why you're investing in the company in the first place. So I think that's the most relevant point. What does an activist want to achieve? And is that achievement aligned to your client's long-term interests? So that's the thing that I would take.
That's the tension, isn't it?
To that conversation, yeah.
And Jeremy, you raised this point, didn't you, in terms of your horizon versus what we just heard is probably a shorter-term one.
Yeah, that's right. And maybe just to add into that, I think whilst we're talking about the makeup of companies changing, the skill sets that are required on boards, which is what the point you're making, are changing. And so it's absolutely right that, as you said, it's not just about climate change here. Actually, it's around social issues as well. You need different representatives on the board with different backgrounds to ensure that you're if you're a low-cost retailer in the US, you recognize that employee turnover and paying below the living wage isn't going to be a sustainable way of running your business in the medium term. So actually building boards with more diversity is going to be important in this. But in terms of, coming back to what you want of an engaged shareholder and how should boards respond, I think it's really important that boards actually present more what I would call non-financial targets around the evolution of their businesses over time. Now, you can think about that in more simple terms, with an auto manufacturer shifting towards its percentage of electric vehicles, but actually you can think about it in all forms of running a business, and a recognition that society's views of corporates have changed significantly, and the Greenpeace activism is now much broader kind of awareness. Companies' brands can get damaged, by CEOs of mining companies in Australia saying crazy things about local, the local populations. So it's so important that there is greater diversity on boards, and that as companies, set forward their plans, they provide, markers that we can measure them against to 2025, 2030. And that's something that we're talking to the companies that we invest about in a lot of detail.
Stephanie, your perspective on this time horizon arbitrage?
Yeah, so I mean, clearly that's there, that's inherent, that kind of long-termism versus short-termism. Lord Miner's report, we will continue to have more reports around it, sort of inherent in tension within the market. I think the point is that the reason that we look as investors, again, to those things, target, strategy, long-term commitments, is because it helps anchor where we think that company is going to go in the long term, regardless of what we know is the sort of cycle of changing boards, etc. So it's, how do you get those commitments, in public, so that you've got an idea around what those deliverables will be and whether they align with what you think is important for the, for that company. And I think within that, there's obviously, also the issues around, what's the role of what is an activist investor really? And I think, over the time, what counted as activism, 10, 15 years ago is just called engagement now. And so I think the question is, what is the purpose of the activism that's happening, and then what are the, I suppose, the tools that are that are being used. But I guess linked to the point around are companies committing to those longer term targets, with medium term targets, etc., is also this question around, what is has the company articulated a purpose beyond that shareholder incentive to a broader sort of stakeholder piece? Has the company articulated that in a way that shows that sort of longevity of purpose? And then also going to the point about the culture. I mean, yes, we're talking about individual board directors being voted, on, off, deemed to be competent or not, have the sufficient skill set. We know all of those things are sort of developing, but also, what does a good culture look like? We know, as investors, we're looking at that. Regulators are looking at that, because that's sort of that, I suppose, the glue that helps guide the company going forward, and is made up of more than just individuals. But we know individuals can have a very considerable positive or negative effect on that as well. So again, this sort of, I think the focus on governance and the board is multifaceted really, and I think sustainability and particular sustainability issues kind of are an opportunity to show or sort of shine a spotlight on some of those issues, but they're inherent in what we look at, and look for as investors, when we're engaging with companies in any case.
Thank you. I've left a little bit of time for questions from the audience. I sort of cheated by having some pre-planned questions, of course, but I'd love to make sure that either here or virtually we have questions. So I see one here. The mic is coming to you.
Thank you very much, Paul Drexler, and thank you for all the comments, so encouraging. I guess two thoughts on my mind. The first is, as we talk about encouraging companies to hive off the nasty bits, to what degree should we be questioning whether we would prefer the nasty bits are managed by good companies or bad companies who want to buy the nasty bits. And the second thought would be, in a quest for making faster progress, to what extent should you as investors be expecting more of companies to speak out against politicians who are making commitments in 50 years with a commitment in reality to what happens the next 3 and getting re-elected?
I do very briefly. My view is it depends whether those nasty bits are actually going to exist in the future. Because if they are, you don't want to be, if they're not going to exist, you don't want to be exposed. But if they are, and we need to think about transition, we as investors need to make sure that they are managed in the best possible quality way possible. So that on that, and companies have a voice to engage with governments. Full stop.
Jeremy?
I mean, I obviously brought up the topic earlier. I think one of the key, look, the devil is always in the detail here, which is really important. When you're engaging with companies, let's pick out coal as an example, you really need to engage with the industry as much as individual companies. You need to see how the industry is relied upon in different areas and how that's likely to change. Where there are cleaner and dirtier versions of coal. So I totally agree with your point about this divestment drive. It should be engagement over divestment in the same way it should be engagement over exclusion within portfolios. And that's not an excuse to continue funding or continue supporting big capital plans to expand assets. It's actually to recognize that asset lives have shortened, but certain investors should ring fence these assets, run them off, and use the capital to reinvest in the opportunities and solutions. And that's very much how I would see this. There are absolutely the correct cases where the wrong owners are owning assets that should be put into other hands and dealt with differently. But I think there's an importance in the transparency around equity markets versus the transparency around private equity, which shouldn't lead to the wrong owners of some of these companies.
And Stephanie, just quickly, if you give us your perspective.
So this thing, transition is around a period of time. We talk a lot around the, what are sector pathways. So it is about, yes, what's happening now and where are we now, but where will we be next year, 2 years, 3 years, 4 years, 5 years, and do we have that planned, and can we demonstrate how that is progressing? So again, I think increasingly, and we talk about how do you decarbonise portfolios, it's not just Xing out certain chunks as well. How do you take those companies? You could have the same companies, and those companies realise absolute real world emission reductions because of they're changing in manufacturing approaches, their operational efficiency, their innovation around new products as well. So I think again, as bringing in the long-termism as an investor perspective as well, how are we there encouraging that transition, which is a multi-year piece, but a multi-year piece where we need to start now, not in 10 years' time.
Okay, exactly, yeah. Well, that brings us to time. So thank you very much for those remarks. I'd like to just summarize by saying we started talking about ES and G, but we ended up talking about ES and A, finishing on activism. I'd like to thank my fellow panelists for their presence and their comments, as well as people in the audience. And we'll now move on to the next panel. Thanks very much.